Okay. In the interest of being very prompt, thank you everyone for being here today. Thanks for joining us. We really do value your attendance. I know it's a busy time of year. So I'd like to start by just introducing myself. I'm Janine Robertson. I'm the Education Manager here at smartMonday, and I'd like to start by acknowledging the many lands from which we come together, pay my respects to Elders past and present, as well as acknowledging any Aboriginal or Torres Strait Islander people that are joining the session. I am coming to you today from Bidjigal country in Sydney, where I live and work, and I'm also joined by my colleague Pat Howard, who is also on Bidjigal land. Hey, Pat.
Hey everyone, how you doing?
Now, there is a question on this slide, and I think it's a real challenge. Today, we want to help you understand some of the factors that can help make you ready for retirement. And I have another question to sit alongside this one. Are you measuring your readiness to retire in dollars or in time? Retirement readiness is not simply a number. It's not an account balance. It's not a level of wealth. It's also a timeline. It's a complex emotional shift and it's a huge lifestyle change. But before we get into all of those details, I do need to remind you, everything we're talking about today is general in nature. You shouldn't consider anything that we suggest today or say to you today as personal advice. We can't answer personal questions in a group forum like this, but your questions are so very welcome. So do please feel free to use the Q&A function. Pat's going to help me out by trying to answer some questions along the way, and we'll also come back to some of them at the end. We did receive some in your registrations, and we'll touch on those at the end. Thank you to those people who submitted questions. I also want to make a quick note if we need to connect with you personally, based on the query that you put in the chat, Pat will let you know and may ask you to contact the coach team or him directly. Okay, let's keep moving. So I hope you agree with me that in super, there's often a focus on building or retiring. There's a sense of saving for retirement or being retired, and we seem to think it's a binary thing. There's two options. But today, I really want to focus on the space between that really does need your attention. It's the bridge that helps you move from one phase to the next, from working life to retirement. That's the bridge where mistakes can happen, where uncertainty sits, and where all those decisions that you've made about your super so far show up. It's also the time when people start planning, testing ideas, maybe reducing work hours, using leave, or simply trying to imagine what might life after full-time work look like for me. I think the bridge is a really complex place to be. So how do you navigate the bridge? How do you stress test it? What options exist? And what would help you make decisions with confidence? It's also worth noting that once you do make the shift into retirement, retirement still has stages and iterations. The bridge sits before retirement, but it's a stage that shapes everything that comes after. The bridge is a place of active learning. It's a time for navigating, for choosing, exploring what works for you. And that's where today's session is going to focus, on that bridge before you get to retirement. So let's quickly take a look at how super actually works once you have crossed the bridge. A quick look at the other side of the bridge to help you know where you're heading. The rules here shift. They have an impact on how long your money lasts, how much time you've actually bought through your contributions and super choices. So here's a quick list of what changes when you do head over the bridge. Of course, access to your super. Tax treatment. Earnings and withdrawals in pension phase can be tax-free, which is a major pivot point. Your investment approach and how you manage risk changes, and we're going to talk about that more in a moment. Also, contribution rules. So the ability to add to super doesn't stop, but the rules do change and get a little bit tighter. There's also some rules about transfers, moving money into the pension phase limits, and it brings its own settings that you need to be aware of. And of course, government support. The age pension does become part of the equation for many. It's not guaranteed, it's not simple, but it can change the shape of your retirement. I really do believe that understanding these shifts is critical, and why the decisions that you're making on the bridge carry so much weight. The consequences of your earlier choices really does become real. So let's say you were ready to cross. How do you do it? It's not uncommon for people to think about retirement really taking all of their super out. That's a common thing that we come across, but it's not how the system works. Your super account doesn't end when you retire, it changes purpose. So instead of it being mainly for savings, it becomes a way to pay you an income. Now, retiring is quite simple. It's not a government process. There's no form to lodge. In practice, retiring simply means resigning from your job under the terms of your employment contract. There's no fixed retirement age in Australia. You can retire whenever you choose, as long as your finances can support you. So an account-based pension is a common way to replicate your regular employment income. You transfer some or all of your super into a pension account, and then you earn a regular income. You withdraw a regular income. You choose how much you take out. And there are some legislated rules, but whatever you don't withdraw stays invested and keeps growing with markets depending on your investment choices. Now, I mentioned on the last slide that tax treatment of super changes once you retire. When you've retired, withdrawals are usually tax-free once you're 60 and you've met a condition of release. Earnings inside a pension account are also generally tax-free, which is really a big shift from your accumulation account. Now, although access does begin at 60, if you meet the rules and criteria, your super is available from age 65, regardless of your work status, and the age pension is separate. That starts at 67. Now, the other point that I want you to hold on to here is about flexibility. Retirement is not a one-way door. If you retire and then later decide you want to return to work, you can. A pension account doesn't stop you from doing that. It just means that you might want to adjust how much you're drawing, how often, and that might be based on your new income and new goals. Now, these mechanics matter because if you understand them, you can make plans and changes before you cross over to the other side of the bridge. Now, I just mentioned opening an account-based pension, or just a pension account. They're kind of interchangeably called those two things. So I want to make it clear to you that there's different types of accounts available to you in smartMonday. That's the column that you can see on the left. Now, you have investment choices in all of these accounts. What changes in the account is kind of how it works and what rules apply. So the first one is your accumulation account. That's the one you've been building while you're working. That's the left side of the bridge from earlier. And then as you start moving across, maybe you're wanting to work less, you want to use some leave, you're testing out retirement, you can choose to start drawing from your super through a transition to retirement income stream. That's the second type of account. Now, it's not compulsory to do this, but it is an option. It's available to people between the ages of 60 and 64 who are still working, and it can give you some real flexibility. Now, if you did want more details on a TTR account, there is a recorded webinar on our website called Pathways to Retirement, but an even better option would be to talk to our coach team because they'd be able to walk you through it for your situation with your numbers. Now, the next type of account is that account-based pension or simply pension account. That's where your super becomes a regular income. So you can set up payments that land in your bank account just like when you're working. Now, I want you to notice the columns on the right, which shows how your tax reduces. I mentioned some of the rules about super changing as you cross the bridge. So a couple of those that you should know is you can only make contributions to an accumulation account, but withdrawals are possible from all types of accounts as long as you meet the rules that apply, being 65, for example. Now, the point I wanted to make here is you've got options at every stage. Across that bridge, before the bridge, after the bridge, your super is your money. So no matter which phase you're in, it's worth knowing that those options are available. Okay, now another part of the retirement system that we often hear about, I think sometimes get confused about, is the age pension, which is administered through Centrelink. It sits alongside super and personal savings. So it's one of those three income pillars that maybe you've heard people talk about. The three pillars being super, the pension, and your other assets. Now, the age pension isn't automatic. And I think that some of the confusion that arises here is firstly just in the names. So you can have an account-based pension in your super and an age pension, which is from the government. They're two different things, but the use of word pension in both, I think it really does sometimes confuse people. So if that's ever confused you, don't feel alone. The second thing that sometimes confuses people here is ages. So you can leave work and retire at any age, as I mentioned. The government pension starts at 67, but that doesn't stop you from leaving work earlier. And access to super starts at 60. If you have the money, you can retire whenever you want. You don't have to wait till age 67. Now, eligibility depends on two tests, an income and an assets test. You've probably heard of those. Centrelink runs both. And the one that gives you the lower payment is actually the one that would be applied. Now, your home is excluded, but your investments in super and other assets are counted. Now, I think it's worth noting that for couples, Centrelink looks at your combined position. Your individual ages also do matter, and it can become more complex when one partner is still working or maybe hasn't reached age pension age yet, which is why understanding some of these rules is really helpful as you're crossing the bridge. Now, sometimes we find that people are surprised that you can draw income from your super and still receive a part age pension, and that depends on your balance. The system is designed to layer sources. It's not a forceful choice between, pension or super. It is often the case that you can access both. It's also not static. So your financial position is going to change through retirement, and it may mean that you become eligible for an age pension at a later stage as your super balance reduces or as your circumstances change. So understanding this is part of the planning, part of the thinking when you're on the bridge, knowing how the pieces fit together before you fully step across. I think it can make retirement seem less daunting. And having a sense of age pension eligibility can be really helpful to reduce stress if you do have a lower balance and you're worried about it. Okay, I want to shift gears. I want you to turn your mind towards investments and how risk changes as you're crossing the bridge. Now, a quick heads up, this graph probably looks a little bit more complicated than it really is, and I want to run through it step by step. So first, from left to right, this is your age, and then that orange line that you can see that rises and then falls, this is your account balance. You're growing your account, and then when you get to that dotted line in the middle, that's retirement, and you start withdrawing from your super. Now, the rest of the content on this graph is about the changing nature of risk as you head over the bridge into retirement. You're not dealing with the same threats all the way through. The nature of risk does change and timing matters. So let's start with market risk. This is the basic rise and fall of investments. When you're younger and contributing, this is the main risk that you face. You have time when you're younger, when you're accumulating. Falls can recover their value. Gains can compound. Market risk doesn't go away in retirement, but it becomes more complex because it doesn't stand alone. As you get closer to retirement, something called sequencing risk becomes one of the biggest risks that you face. So that's the box that you can see in the middle of the graph. Now, sequencing risk is not about how much markets move. It's about when they move. So here's why it matters. If markets rise just before or just after you retire, your balance gets a lift at exactly the right moment. You start drawing on it, your balance goes up, and that's ideal. A higher balance gives you a stronger buffer, it gives you more flexibility. But what if the opposite happens? What if markets fall at the moment that you retire? You're withdrawing money from a balance that has dropped, so your losses get locked in. And then the combination of poor returns and withdrawals can shorten how long your savings last. So that's sequencing risk, the order, the sequence of investment movements. Now, it tends to matter the most in the decade leading up to retirement and the years soon after. Timing becomes a risk factor in its own right, and this risk really does kick in when you're on the bridge, not just when you cross it and reach the other side. Now, diversification is something that's important in your super, spreading your risk across different assets. And it does help reduce your sequencing risk because not all of your assets will rise or fall at the same time or to the same extent. For members who have their super in the Smart Monday life cycle option, your investment mix will automatically shift and reduce your market exposure as you get closer to retirement. It accounts for sequencing risk. So if you've not made an active investment choice, then you will be in the life cycle option, and we've been looking after your sequencing risk for you. The next risks to think about are the ones listed on the right: inflation and longevity. Now, inflation is about rising costs and purchasing power. So think about something that costs $50 today. In 20 years' time, with a 2.5% inflation rate, that same item could cost around $80. Now, retirees might feel this more sharply because their income isn't rising with wage growth. So investments need to grow enough to keep pace with inflation and with rising costs. Which brings us to longevity risk. So longevity risk is just the risk of outliving your savings. People are living longer with improvements to healthcare, which is fantastic, but it means they need their super to last often quite a long time. You could be retired for 30 or more years. Longevity risk grows the further you move into retirement. So when you think about longevity risk and inflation risk, you can see that you do need to ensure that you've got some investments that take on a higher risk level to help protect you, but you also need to balance the market and the sequencing risk. And this is where support can really make a huge difference. Someone to help you align your investment mix, your balance, your comfort with risk so that you're not navigating this alone. Now, I'm going to come back to this, but advice really is great in preparing for retirement. It's really worthwhile to help you understand these things that I've been talking about and make decisions for your own circumstances. Okay, a lot of what I've been talking about is the mechanics, the rules. If you were planning retirement like we plan a holiday, maybe you could suggest we've been talking about tickets, passports, visas. But part of the planning is also about choices. So where and when do you want to go? What will you do? There's a lot of factors and options that you can consider. Before you reach the other side of the bridge, time does become your most important variable. These years shape how smooth that bridge might be. Retirement doesn't have to be a single decision. It can be staged. It can be a process that helps you buy time, not lose it. You might want to stay in that bridging phase for a while. Now, reducing work hours is one of the most common things that we see. It lets you ease out of full-time work without cutting that cord completely. It's where a transition to retirement pension can help bridge that gap in income as well by starting to draw on super. It gives you a chance to test a different pace. If you're between the ages of 60 and 64, could be something worth looking into. Now, many members tell us that this kind of gradual shift helps them adjust to the reality of retirement, not only by changing their daily routine, but also by starting to get used to this idea that super isn't something you build, it's also something you eventually draw down from. You might want to use leave strategically. That's another option. Create some trial periods of retirement. And I think it's worth acknowledging as well that your partner's timeline, if you have one, does matter. You might want to leave work at the same time. Maybe you're thinking that one person should finish first. That might be better for you. So thinking about age gaps, different work patterns, timelines, it's really worth doing because it can help you avoid some of those surprises when you're on the bridge. Now, these decisions don't have to be dramatic. They can be a series of small, controlled steps and adjustments that let you test out what's working for you financially and emotionally. The bridge might be a period of experimentation with a goal to use time deliberately. So when you do fully cross the bridge, you're doing it with confidence and with clarity. Now, I don't want to spend too much time on this slide, but I do want to acknowledge that there are things that come into retirement planning that are much broader than your own preferences. Life around you can shape the timing and the money that you might need. You might be supporting adult children, helping them into housing, having them at home longer than expected. At the same time, we're seeing a lot of people with aging parents who might need support financially or with time, and these pressures do compete, and they can influence retirement and how far your savings need to stretch. Your home is another major factor. Downsizing can release equity, but it may allow you to make extra super contributions, which is fantastic, but comes with costs and age pension implications. Remember, the family home isn't counted in the age pension assets test, but money you free up from a sale usually is. So changing your residence can be a great way to move forward towards the lifestyle you've been planning, but make sure you get the info you need. Now, legacy decisions matter too. If you plan to help family members financially, be aware that Centrelink counts gifts and transfers above certain limits. And on the other hand, receiving an inheritance later in life can affect your age pension or tax position too. And then it's worth thinking about estate planning. How do you want your wealth to pass on to family, to causes you care about? These can influence how you spend and invest today. Now, these factors all connect. Family, home, legacy all shape retirement planning and can have an impact of the timing and when you feel ready to step across the bridge. Now, we talk to members every day about retirement planning, and you might be surprised to hear that the hardest part of retirement usually isn't your actual account balance, but it's the shift from a lifetime of saving to starting to spend what you've built. Many retirees struggle to draw down their super. There's decades of saving, which has created a habit, and habits really are hard to break. So even people with strong balances do feel this fear of running out of super. And the fear doesn't just disappear if they know the numbers are fine. The mindset shift is unfamiliar. You've worked your whole life, you've grown your balance, and then suddenly the goal flips. You're meant to use it, not protect it, and grow your balance. So it is important to recognize the psychological side of retirement and spending. Hesitation to spend is really quite normal. We see it all the time. But if you don't acknowledge it, it is something that could become a barrier, and it is something that could hold you on that bridge longer than you need to be. So how do you manage it? Well, firstly, I would say having a plan and sticking to it. Second, don't look at your balance every day. When people are worried, they tend to check on their super a lot, but sticking to your plan is a good idea. So having a clear plan, knowing what you're comfortable to draw from super can mean that you can spend without guilt and enjoy the lifestyle you've been planning for. Now, I know there's a lot of words on this slide. It is one that you might want to come back to in the future. Being ready to retire isn't just about the number on your super statement. There's a point on the bridge where you need to stop. You need to take stock personally as much as financially. And you don't need perfect answers. You just need to know what's clear and what still needs work. So let's start with the top line there, age and access. Do you want to retire early? Do you want to plan for that? It's not just about what the rules allow. And also ask yourself the leverage question. Will additional contributions now buy you time later? Because contributions don't just lift your balance, they can pull your retirement date forward. Next is work and identity. What are you going to do if you're not working? Work really does give people structure. It gives people purpose and social connection. And if you don't replace those deliberately, retirement can feel flatter than most people expect. So think about what fills that space in a way that actually feels meaningful. Third is relationships. How will your retirement change daily life for your partner or for your family? If you do have a partner, are you both on the same page about timing and lifestyle? If your expectations aren't aligned now, that mismatch really does show up, often as stress. Now, health and well-being is really important. The mindset shift, as we just talked about, are you retiring from work or are you moving towards something? People who retire with a purpose tend to transition better than people who just stop. And then last is finances. Now, super and money, I think, have a tendency to override the retirement conversation. And I'm not saying that the money is not worth focusing on, but taking stock of some of these other questions helps you form a plan. Then that plan helps guide the numbers. You can then ask if your super and other savings realistically cover the lifestyle you want. So if you're feeling a bit unsure about that, using the Smart Monday calculator is a first great step, a reality check. It won't be perfect, but it will tell you if your assumptions are in the ballpark before you go a bit deeper. And if you've got clarity across these 5 areas, you really are in a strong position to test options and set timing with confidence. If one area is unclear, that's where to focus. Okay, we said this earlier. When you're ready to retire, the mechanics are quite simple. There's no special government process. You can resign and let your employer know. If you're opening an account-based pension, the setup is mostly paperwork and an application form where you choose your investment options, set your income payments, confirm your details. Now, getting help from the coach team at this point is worthwhile, so the setup is really clearly matched to your plan. Now, if you're creating a pension account, it's worth noting that pension accounts don't have insurance attached. If you transfer your full balance, insurance could stop altogether, which might be okay, but it is worth noting and considering for your circumstances. Once cancelled, insurance might not be able to be reinstated as easily, so it's a mistake to avoid and always worth checking the fees and costs before taking action. So each account, including your new pension account, needs a current beneficiary nomination. It's a small detail that has big consequences if something happens to you, so worth getting right at that stage. I just want to remind you that opening a pension account doesn't ban you from working later. You can return to work if your circumstances change, if you choose to. The system recognises that intentions change over time. The point is that the actual process of retiring is really quite straightforward. But once the thinking and planning are done, you can move into this as a practical process. Get the paperwork right, be careful with your insurance, set up your account. And remember that the options remain open if life shifts. Of course, seeking advice at this point is a good place to go as well. Oops. Okay. Now, we've covered a lot, and I really want to make sure you know there is help available. I saw some research earlier this week, actually, that confirmed financially unadvised Australians were twice as likely to be extremely or very worried about outliving their retirement savings. It also suggested that advice is most impactful when you're heading onto the bridge to build confidence and reduce worry. So here's how you contact the team on your screen right now. And I just really can't emphasize enough how important this could be as you head towards retirement. Getting answers to your questions is a game changer. So as you can see, there's a number of topics you consider and speak about, and I'm going to leave this on the screen for just a moment. All these details are, of course, on our website. But before we wrap everything up and move into any questions that have come through, I just want to make sure as well that everyone's clear on action points. Do you need to revisit some of the areas we've talked about, like work, identity, timing, relationships, purpose? Do you need to jump into a calculator and get a sense of where you stand? Or are you ready for advice, ready to start making those plans and locking some things in? I really do value your time today, but it's really important that you have a plan for the next steps. So I thought I might actually share what I'm doing. I'm stepping onto that bridge, and I know that looking at your super balance over summer might not be too glamorous of a way to spend your time, but I will definitely be talking to my husband about timing. What's our goal? I've got a good sense of my ideas, but I think maybe we haven't formed a solid plan together that we're both really comfortable with. And I probably will jump into those calculators and see how we're tracking. So if you want to take a look at any of the content from today and revisit any of those questions, the presentation will be on our website in the next couple of days. You don't have to listen to me again. If you just want to fast forward and pause the slide to get any of those details, you can. As I said, your being here is really important, but what you do next really does matter. Okay, we've got time to move on to some questions. So Pat, I might ask if there's anything in the chat or if we should have a look at some of the ones that came through in the registrations.
Okay, I'd say we do a hybrid because I know some of the ones that we did get from registrations, and we've
Mhm.
had Meta and Denise just ask some questions now, so thank you. And I think I'll answer those
Mhm.
in with some of the questions from the chat, so because they're all sort of context together.
Excellent.
But if you've got questions, keep dropping them in, and I'll try and look both directions at once, and we'll get there. But so yeah, what have we got there, Jen?
Well, we did get lots of questions about how. So,
Yep,
how can I access my super? How can I use it? How do I set it up to work with pension and with my life? I
yep,
think that's kind of a practical question rather than the theory behind retirement.
yep.
So, is that the kind of questions you've got in the chat there? What are people
Yeah,
curious
we
about?
do. Yeah, so we've got a couple there. Okay, so if we go with that, right, I think we've spoken a lot today about, looking ahead and crossing that bridge, and then what do you do? Um, I think, yeah, really, really important to reiterate for everybody that you do have choices, and there's quite a few things you can do. You can draw money out of super, you can leave it, you can open a pension, or you can do a combination of those different things to suit you. And there's no right or wrong, so you really do have lots of options. Um, Now, we had questions about, how do you access the super practically? Just
Mhm.
people often ask us, and we see that, how do I do it? You can log into your online account and do it, or you can fill in a form. It's really easy. There's no secret handshake or hoops you have to jump through. If you spent the time saving up for retirement, we're not here
Mhm.
to get in your way of that at all. We want you to
Mhm.
have a great retirement. Get in touch with us, jump online. It's actually quite easy. Main things being, as you spoke about, that generally super access starts from 60
Mhm.
if you've retired, or 65 regardless of your work situation, um, or there's a transition to retirement account, which is kind of in between, which lets you bring that forward a little bit.
Mhm.
Um, Now, one of the questions we did just get in the chat, Meta asked, at what age can one open a pension account? That's a really good question. So once you reach 60, if you've retired, you can open a pension then. You don't have to wait till you're 65 or 67. It's
Mhm.
once you move into that satisfying the rules of super that you can access your super, you'd be in a position where you could open a pension account, you know, on your 60th birthday, if other things being equal, if that was what you wanted to do. So that was a really good question. Um, Now, Denise has also asked, she's asked, you say we can go back to work if we want to, but does it mean drawing down or access to the super stops, or can that be concurrent? So
Good question.
that's one that we do get quite often because people's circumstances change, their plans change. You know, as you noted, sometimes people retire and it's actually the stop is actually more of an abrupt change to their life than they
Hmm.
thought. They might want to go back to work. So but that one, Denise, I'm rabbiting on about for ages, but if you've over 60, you've finished work and you started accessing your super, you started the pension, no problem. And then you do go back to work. Now, if you're under 65, well, sorry, I'll go back from that. But if you basically the super you've accumulated up until the point you started accessing it, you could keep accessing that. But then you go back to work and you start earning more super, you can't access that new portion until you again finish that role or retire or reach 65. So you've kind of got two super eras in your life, one before you stopped working and one after you went back. But you don't get penalized for making a change. That's the really key thing to know. And yeah, Denise has noted there, sort of understanding and thinking, hey, do I need to top up my finances if the age pension isn't in play or I don't qualify for it yet? And that's exactly what this whole presentation is about, is that bridge and understanding your options and how you work those together. So that's, Denise, you're a star. Thanks for asking. That's exactly what we're talking about today. And we had people ask in some of the other questions about, should I draw it all out? Can I, if
Hmm.
I open a pension, can I take out more as well? That's a
Hmm.
really common question, an excellent question. And yes, so if you set up a pension, you can get that regular income coming in every week, but it doesn't mean that you can't dip into it and take out a chunk if you want to go on a holiday or buy a car or something like
Hmm.
that. You still have all that flexibility. So yes, that's something you can do. Um, I know some people are asking about pros and cons of a pension or leaving in your
Hmm.
super or drawing out. Pros and cons for all of them. If you draw your money out and put it in the bank, really easy flexibility, but you've got to be responsible to manage that as well. You're someone that's good at your spending. Pension lets you keep getting paid like you've probably been used to your whole working life, which is really comfortable for people. It's really reliable. So there's, yeah, that's a pro. Investment returns in a pension are untaxed, which helps it last longer. So that's a really great feature of pension. So there's no right or wrong there. I think that's the main thing for people to understand. But thinking about your options and understanding how they work together is really key. But you've got lots of great options when you do choose to retire. Um,
100%.
yeah,
Okay, in the interest of time, Pat, I'm going to move you on to the
yeah,
next one.
please.
Whenever we run a session, people ask us about property, and I think that that really does make sense. In Australia,
Yep.
property and super are often two of our biggest assets, especially when we get to retirement age. I think Australians are kind of obsessed with property, and your home is part of your retirement considerations, as we talked about before, things like the age pension. So have we got any questions in the chat there about property, or do you want to just cover off some of those topics?
No, so I don't think so. Just we had quite a few come in. So, geez, people, great questions. So in terms of property, no, there's no property questions in the chat, but I think key thing to think about property is, yes, it's a big pillar of a lot of people's finances. It's a massive
Hmm.
asset for most people. It may be bigger or, you know, equivalent to their super when they retire. So property is outside of super, so it's not
Hmm.
necessarily a consideration fully for this chat, but it's definitely part of your finances. So yes, there's considerations about your property, how that's treated for the age pension. It's exempt, so it's a big asset. It's exempt, and you obviously need somewhere to live. So keeping that in mind,
Hmm.
people often ask, "Hey, when I retire, should I take out all my super and pay off my mortgage?"
Hmm.
Again, really big consideration for people. That's neither right nor wrong. It's really circumstantial. And if you
Hmm.
need guidance on that, we really encourage people to get that support because it's a big
Yep.
decision. And it's not one that we can advise on because it does lay outside of your only super circumstances.
But we
Um,
can talk to you about the implications of removing
yes,
that lump sum and
exactly,
what
exactly.
does that mean for your super and your retirement income?
That's exactly right. But yeah, we couldn't sort of tell you this is what you should do though, because there's bigger considerations. But we can still talk to you
Hmm.
about it if you want to understand the lay of the land. Um, and the other thing is there's potentially what's called a downsizer contribution. A lot of people move
Absolutely.
go smaller to unlock equity from their property or make that lifestyle change. And
Hmm.
there are rules in super that might let people use proceeds from that to actually boost their super in a tax beneficial way. So
Hmm.
lots of good questions around property. Reach out
Okay.
to us, but hopefully that clarifies some of those. So,
So another one that we hear about, so kind of thinking about property in a way, people often make kind of a big sea change. Sometimes people move overseas. So
hmm,
what happens to super when you're retiring if you're not in Australia?
okay, excellent one. And I think Stephen might have asked the overseas one as well. Um, no changes. I think that's a really key thing to keep in mind. If you do move overseas, there are tax changes and residency changes and all sorts of governmental things that you might need to consider.
Mhm.
Super isn't necessarily one of them. If you move overseas, all the rules of super still stay the same. So you can only access it once you've reached 60 and retired. Um, that you won't get penalized if you draw it out simply because you're overseas. So to flesh that out, if you have Australian super, it is what it is. The rules haven't changed. If you draw it out, it's got to get paid to an Australian bank account. And what you do with it after that and any tax implications and things like that are outside of super. It's a tax question where you consult a professional. If you have moved overseas and you haven't been active in your super, maybe that's a consideration because there are rules around super where an account's inactive, where it might have insurances cancelled after a period of time, or if the account balance gets low because it's inactive, it might be transferred to the ATO. So they're considerations to make as well. Make sure you check on your account. And if you're overseas and you do want to boost that account, you can still contribute into it. It just needs to come from an Australian bank account. So you can still participate.
Okay, I've got one last one here, and then we'll wrap things up. So, one of the questions was about what happens if I contribute over the $30,000 annual concessional contributions cap.
Okay. Yes, that's a really common one. And coming into retirement, people often want to boost their balance before retiring. So there are caps on how much you can put in each year. The concessional contributions is 30,000. Now, if you've got unused caps from earlier years and your balance is under 500,000 at the start of the financial year, you might actually be able to contribute more than 30,000 and still get the concession. So worth knowing about that if you haven't heard about it. Now, let's say you weren't eligible and you've gone over the 30,000, that amount gets taxed at your marginal tax rate and you get a rebate or offset in your personal tax return. So you're not going to get penalized per se, but you won't receive additional tax benefit if you go over. The government regulations will bring that back into balance and make sure you're getting taxed the right amount. But if you went over, you don't need to fear it too much and you can take action there. So, yeah. Um,
Awesome. Okay, I think we're going to wrap things up. I am
yeah.
going to launch a couple of quick polls on your screen. Anyone who can give it a click, I would be really grateful. We love hearing from you. We love all your questions and we really appreciate your time today. Thank you so much for being here. Do remember to reach out to the coach team if you would like to seek further information, get answers to questions, or seek advice. Thanks again. Hope you have a great December and summer break, and we look forward to seeing you back at the next one in the new year. Thanks, everybody.